Well, good morning, everybody. Victor Adair sitting in for Michael Campbell again this week while Mike is on vacation with his family in Europe. And there's an old saying in this business of you want to start strong when you're going to do something. Well, I'll tell you what, my son alerted me to a video that was out there on the internet about 3 or 4 months ago. I went and I watched this fellow, JJ, talk to our friend Tony Greer, who's been on our show several times, been out to our conference a couple of times. And then I saw him talking with my old friend Kevin Muir. And then I saw him talking with Maggie Lake. And I thought, I got to get JJ on. And I found out that JJ and I used to both work for Conti Commodity back in the 1970s. He was on the floor in New York, and I was out in Vancouver and San Diego working out here. And we never got to know each other. So here we are. I'm thrilled to death that you're here and get your perspective as somebody who's been trading commodities even longer than I have been. JJ, welcome to Money Talks.
Thank you, Victor. Pleasure to be here.
Well, it's so good to be here. Now, listen, I know you've got some family ties to Canada, and our audience is mostly Canadian. And lately there's been some people in Canada getting upset with Americans a little bit. So tell us how you actually really could have been a Canadian.
I was born in upstate New York in Watertown, and my uncles, went off to the Second World War, and they married women in France. And so when they returned to the States, they settled in Canada, the Laurentian Mountains in Montreal. And so when I was a child, I spent a lot of time in a place called Senegath. And my grandfather's sister, a little distant here, married a guy named Isaac Walton Killam, who was a very successful financier in the 1920s, 30s, 40s, owned a large chunk of Royal Canadian Securities, and died with a great fortune. They gave it all away. McGill, the Thida Foundation, various hospitals in Canada, and so forth. But so I could have been a Canadian, but my dad, he stayed in New York. So.
Okay, super. Anyway, that just gives us a little taste of that. Now, I did say you were on the floor in New York. Now, I do remember, and I think a lot of our listeners are going to remember when gold took that run in 1979, 1980. And interestingly enough, it really kind of took off because the Russians invaded Afghanistan back in December of 1979, and that gave the goose to the gold to run to the upside. And certainly here in the last couple of years, Russia invading Ukraine gave gold a spike to the upside. So some similarities there. I mean, we could do nothing but talk about some of the stories from being on the floor back in those days. But I mean, Norton Waltock is the name that comes to mind. You worked for him. He was the guy that when he walked on the floor of the COMEX, the silver market would go limit bid in those days. I mean, give us a taste of that time.
So I went to work for Conti Commodities at number 2 Broadway in 1975 as a runner, and I worked my way up, and they sponsored me to be a sales guy with a Series 3. And I did pretty well with that, so I bought seats on the floor, and I went to the floor. And Norton was an amazingly gifted, old school desktop speculator. He never did anything small. I saw him corner juice twice, sugar once, and he was in this cabal of guys that corner silver. And all of that took place months before the Iranian hostage thing and the Russians went into Afghanistan. But, I think whether or not that happened, whether there was trouble in Iran, it really, juiced everything. But can I tell you about Norton? He used to smoke foot-long cigars. He wore plaid pants. He, he's an old school New York mercantile guy, butter and eggs trader, potato trader. Just made a fortune doing everything in those days. But the floor had a great advantage over the rest of the trading public, even the banks. because everything went through us, and we saw everything, and we could do things that the banks do now that they couldn't do. We could cross orders, and we saw order flow. So if you, I guess, just one little anecdote. When the silver corner was really hot, some of the guys in the silver pit would pay their clerks to stand by the elevator banks to wait for Norton to come up to the floor. And when he came out of the elevator, they would run down to the pit, and, or they would be on the phones and they would call and say he's coming. And he really didn't care. He wanted the floor traders to know he was coming, so that they would all get long,
right,
and they would have volume to sell him, because he didn't want to be, picking like 3 lots and 5 lots and here and that. He wanted to buy hundreds or thousands, which he did. And I guess in the latter part of the corner, there was a lot of tension, because they were buying silver on the COMEX, receiving it, taking delivery of it, putting it on a plane, shipping it to Zurich, borrowing against it, collateralizing it, and getting the cash back. So sometimes there was a bit of tension, because silver wasn't always straight up. And if you had, in those days, we didn't have position limits. There was really just the exchange and your ability to margin your position. So if you were running 20,000 lots of silver and it went down $1, it's 100 million ounces of silver. So it's like, it's just a lot of times there was some let's say concern whether or not the money was going to come in from Zurich. But as soon as it did, he'd throw on his trading jacket, go up to the floor, and boom, silver went up. Went from 6 to 5, 6 in like May, if I'm remembering correctly, in May of '79 to 50 by January in 1980.
So coming to that, I mean, everybody remembers gold going to 850, but it was the silver that went, and that was actually the all-time high. Silver's never traded above that high if you get right to the pennies that happened. But I remember coming in one weekend, I guess the Monday morning I think it was in January, and we had a guy who would write down what that silver had been fixed in London before the New York market opened, and it was down $13, because over the weekend, the exchange, the COMEX, had put a liquidation order only out there for non-commercial accounts. So if you weren't a commercial, you could only liquidate what you had on, and that was it. And of course, a lot of those people were speculators, and that accounted for silver breaking $13 an ounce. And I often wondered, or often thought, that it was the silver falling that caused the gold market to stop going any higher.
Absolutely not.
No?
Gold broke first. No.
Oh, okay.
Silver broke second.
Okay.
As a matter of fact, well, gold didn't really break. But, in those days, I can't remember precisely when it was, but gold was much, much bigger capital market. I had a lot of clients in Europe at the time, and, occasionally I'd go over and see them. One of them was Deutsche Bank in Frankfurt. And a guy named Fritz Blass was running the gold desk there. And I got to watch him, do the morning fix, sit in, which is a great honor, really. And they had guys that were throwing around, 2, 3, 5 million ounce day trades in gold. I mean,
Wow.
if our market here in the electronic market, with the kind of thin, I guess, commitment of the financial community to support big speculators, like a lot of Saudi money, a lot of Middle Eastern money was trading gold in Zurich at those times. And Zurich was really, and Frankfurt was huge. London was huge. New York was just kind of, just getting going. It was a COMEX. It was a new thing. It was, a public market with futures and so forth. These guys, I was visiting the Union Bank one day. That's on the Paradeplatz in Zurich. And that guy, the guy was running as Cesare Corte, was an Italian guy, really nice guy. And gold was down big. I don't know why it was going. It was down about $40, and he was buying it, millions of ounces. And he said, in a market like this, you just have to have a view. And I was thinking, man, this guy's got at least $100 million P&L swing going on him here,
Wow.
right? But these were the big Swiss banks,
Yeah.
and they were massively liquid. They had the ability, and they had the commitment and the culture and the history of gold to dominate the market in that way. For them to come into the COMEX on any given day and buy, I don't know, 5-6 lakhs of gold, 500,000 ounces, would just be ordinary. And we got to do that brokerage. It was phenomenal.
What an insight. And of course, America had been unable to deal in gold for 40 some years, leading up to 1975. And January 75, Americans could own gold for the first time in 40 some years. But the Europeans had this long history. They'd never been locked out from trading gold.
They were gold.
They were gold. Perfect.
They were gold.
Hey, let's JJ.
Just one more thing. I'll say one more thing here.
Yeah.
For your listeners. And of course you'll remember this. In the 70s and until the early to mid 80s, there were only two things. There was the stock market and there was gold. We didn't have bond futures. We didn't have any of the fancy stuff. We did have some budding currency futures on the CME. We had bellies, we had grains, we had softs, we had the Merc. We didn't have crude oil. We had gold and silver, but silver was an LME metal for a long time. So if there was any stress, money went to gold, not to bonds. There were no other derivatives. If stocks were going down and people were worried about what the economic future was going to be, everybody went to gold. So when the 70s got kind of nutty and we had inflation and Nixon resigned and New York City was going bankrupt and so forth, all of these things, there was nowhere else to go but gold. That's not the case right now. So I just want to make that point.
Hey, great point. Well, let's actually go to now. Gold now. Here it is, 50 years from those days. And the gold market has been, it seems anyway, going up relentlessly. Something that you wrote, actually segue here, folks. I discovered JJ and I immediately became a subscriber to his Substack. He writes a morning letter and an evening letter, and I love it. And it costs me $29 Canadian a month to get this incredible flow of information. So go to Substack and find what do you call it? Market Vibes, right?
Market Vibes, yeah.
Market Vibes. Okay, it's worth looking at. Now, but you cover gold. You certainly look at the stock market, the energy markets as well. But we've just been talking gold. What's your current day take on what's happening in the gold market?
Okay. It's ridiculously high, but it's ridiculously high for a reason. Just to give you an idea how high it is, right now an ounce of gold will buy 50 barrels of crude oil. If you went back to the highs in, let's say, 2008, it would only buy 10 barrels of crude oil. The relationship of gold to almost everything is just off the charts. It'll buy, this morning it would buy 103 ounces of silver, 1 ounce of gold.
Saw that. Yeah.
And Canadians know that the traditional relationship for gold silver should be, well, somewhere around 60 or 70 if we were going to look at the last 2 or 3 decades. But if we were going to look at the last 1,000 years, it should be more like 15 or 20. So to have it be 5 times that just gives you an idea of how extreme the premium is historically to everything else. So that makes me cautious, with oil, and Trump and what he's doing. There's not really a lot of inflation in the West. We're I mean, we've kind of living in the illusion that 2% equals zero, but that's okay. I mean, if you have 37 trillion in debt, you're going to have a little inflation, or everything's going to collapse. Maybe we need to have 3%. And there are many other alternatives to gold, depending on what highly rated bonds are yielding, like Exxon or something like that. Those bonds, they're very safe. Let's just say that. So we didn't have those in the past. So comparing apples to apples, saying gold is going to go to the same kind of premium of 850, and we're not at that level right now. By the way, if we were to take I guess the dollar to be about a tenth of the purchasing power that it had in the 70s, just a hip shot, that would mean gold would have to go to 8,500 to be where it is. So let's just say gold is in constant dollars. You can put it on Bloomberg; they'll calculate it for you. It's probably, if we were to use 1974 as a benchmark when it was legalized, 1975, it's probably a $250 or $300 commodity.
Mm-hmm.
So I often say gold never moves. It's the one thing that doesn't move. It's like the sun in the center of a financial solar system with all this other stuff orbiting around it. Gold just stays there. It's like it's kind of like a pituitary gland for money. And so right now, relative to everything else, all the metals very high. Relative to gold, oil, very, very high. It's not high relative to stocks. It's about 25% of its relative value to stocks that it would have been in the Y2K dot-com bubble, and about the same for the S&P as well. So I think that relationship is going like this. So gold could stay here, 2,500. I don't think it's going down, or it could go down $500, but that's not down. That's just a swing. I mean, for most of us, if we go down and we buy 10 Krugers or 10 Maples or something like that, it's 30K. So, and it goes to 25K, we're not going to be pulling our hair out. We're not even going to be thinking about it, And that's one of the things, I think, one of the many things that's keeping gold bid. So the other thing that's keeping gold bid, this is kind of wonky, but stay with me. I'll try to make it clear. As the paper world after the crash in 2008, QE, and so forth, one of the things that they had to do is they had to really tighten all the regulations around risk management. And one of the things that no one has ever liked in the financial establishment is gold. It's antithetical to what they want to do. It's, the nanny wagging the finger. No, you can't do that, right? And they, so they cut the position limits on the exchanges. If you were going to buy a lot of gold, you could only go through a handful of broker dealers that actually had access to the kind of volume to buy millions of ounces of gold. So that just doesn't happen anymore. And if you're going to buy, let's say, silver, if say somebody wanted to buy 100 million ounces of silver, it would be incredibly difficult. For instance, in July 1997, this is a great story. Warren Buffett looked at the price of silver, about $4 an ounce, and he thought, "Oh wow, that's cheap. I think I'm going to buy some." And his partner Munger said, "Warren, don't do this."
That's right.
No. I think it's cheap. I'm going to buy some. I think the famous quote from Munger was, "Warren, the amount of money you're going to make if you buy 100 million ounces of silver isn't going to change the amount of money you'd make playing bridge with your mother, right?" You've got a $5 billion Coca-Cola position, and here we are. You're going to spend all this time, cramming $900 million into silver. Well, Buffett went ahead and did it anyway. So he started buying silver on the COMEX, and it went from 4 to 5, 5 to 6, 6 to 7. And by January, excuse me, I'm just going to grab a Kleenex here. Okay. By January of 1998, Warren Buffett had bought every ounce of silver in the United States and everywhere else that was, pretty much in the available float. The spreads had gone into steep backwardation. Most of Wall Street was freaking out. Who is buying all this silver? So one of the big bankers got in touch with Bob Rubin, who was the Treasury Secretary then, and said, "You got to help us out, man. We're all, we're way over our skis. We can't get the silver back. This can be really bad. We're going to have a really bad situation." So Rubin found out through his, his connections, Warren Buffett's buying the silver. So he called him. He said, "Mr. Buffett, stop buying silver. You are really putting the hurt on all the banks. And if you don't want to alienate all these people who are financing many of your deals, and, you're running, I don't know, billions and billions of dollars through this other stuff, just quit." All right. So, and by the way, make a statement, say you're sorry, and you're not going to buy anymore. So he did.
He did.
He did.
Okay.
He said, "Well, sorry, I really didn't know. I wanted to buy 200 million ounces because it was really cheap. And I only got 130 million ounces, and I'm not going to sell it. I'm going to keep it, but I'm not going to buy any more." And it was like a really interesting meeting in Omaha in 1998. They had YouTube clips and stuff like that. If you want to go to YouTube and look at it, it's a riot. So anyway, he held on to the silver, and he sold it in 2006 for about $13 an ounce, which is a typical Buffett trade. But what my point is that to buy 100 million ounces of silver is really, really hard.
Okay.
And you can't get it on the COMEX because you can only take delivery of about 1,500 lots every month. So the maximum you could ever get if you took, and they know who you are, and you have to have special waivers, and you have to be vetted in order to do it, would be like 7,500 lots, 15 million ounces in a year. So if you're going to buy it through a bank, you got to go through the bank, right? The bank's going to say, no, don't do that.
Yeah.
That's going to really screw us up. So, so the only other way that you can actually buy a lot of metal now is over in Shanghai on the SG. And people figured that out. So, I think probably from 2014 to this year, China's been importing somewhere between 1,000 and 1,500 tons every year. So, in those years, 14 to 20 anyway, we were only producing about 3,000 tons. So China was taking all of the available float out of the market and about half of global production. Yeah, China produces about 350 tons every year, and there's no exporting. They keep it all.
Mhm.
They buy the Australian production. This year, we're going to produce 4,000 tons, 125 million ounces, probably have another 30 million in scrap. So it's just a lot of gold. But we're still going to have a deficit for demand because of the gold going east, which is why it's at $3,000 right now. And so circling back to another reason, the smaller dealing community got to do a lot of things that they said they were doing, but they didn't do them, right? So if you're trading gold with one of the bullion houses, let's say you want to buy 85,000 ounces of gold because you have some reason for it. Either you're an industrial, you're making motherboards or phones or something like that. So they sell you that, and then they buy they hedge it on the COMEX, and they buy the spot gold, and that keeps it as a closed deal, and they're supposed to hold that spot gold. And so the EFP, that swap position, was an embedded part of every big bank, and it grew over the years to be really very big, millions of ounces. And because you don't make a lot of money on EFPs, this is a really tiny little amount. You do a lot of it. And in order to service the mining community and the very, very narrow channels that mines have to sell it, because there's not really the old gold fix like they used to have. You have to go through the banks. And every year, as you get towards January, there's a kind of a funding crunch to get over the turn. They probably, you've probably heard of it. And so around November, a lot of the big banks, and this happened in 2020 when there was COVID, started thinking, wow, we are funding tens of millions of ounces of gold in our EFP books. And we need that cash. So they call down to the gold desk and say, cut your EFP book in half. We need to lose like 3 million ounces by next Friday. And, you work for these guys. I work for a bank. And when they say that, you sell that gold or you don't have a job, right? So covering the EFP, long gold, short futures, created a shortage of futures. The demand to cover the EFPs, to buy all those futures. The futures are just like any other commodity, right? They're not an infinite supply. There's the short side of the open interest of the book, and anybody else who wants to create more open interest by selling it. But in order to do that, you got to take it up. So the normal EFP, I guess, in the first week of December 2024, went from $8 to $40. $8 was the cost of money. So it went 5 times the cost of money just to get the futures back. And then they sold the gold, right? So when they sold the gold, they had to get the gold to deliver it, which means that if they didn't actually have all those millions of ounces, because they don't have their vaults, they had to go to the Bank of England and say, hey, we just sold 1 million ounces of gold. We want to borrow 1 million ounces of gold because we have to deliver what we sold it to. And so the Bank of England was facilitating that. So all of the physical side of the gold was hypothecated. And on the future side, there was no supply of futures. So if you just went like this, and it's just ripped. And, everybody was like, what's going on? It's crazy. So I knew what was going on. Some of the other people who've been in gold all their lives knew what was going on. What we didn't know is that the Bank of England was going to run out of gold. And they have 160 million ounces of gold, they say. They hold in custody 1,200 tons for the Germans, or I think, 400 tons for the Germans. They have 350 tons of UK gold. There's a lot of gold. So all of the free float of the London LBMA got consumed as the spot side of the EFP book was liquidated, because the buyers of that gold, they want their gold. I buy gold from you. I buy 100,000 ounces of gold for you. I pay you in 2 days. You give me gold. That's the deal, right? But the banks themselves have tendrils of credit where they can borrow gold. They can borrow from any of the central banks, but usually they go to the BOE, right? So at any rate, I think the total amount of gold involved of all of this was somewhere around 70 million ounces, which is no small amount of gold. And the BOE ran out. The futures were going up and down like crazy, 5 times the cost of money. And those banks that had balance sheet were able to not really easily, but they did it. They bought physical gold and they sold futures for February delivery in December. And their gamble was, although there was a shortage of physical, clearly in the first week of January, that they were going to be able to get LBMA bars, 400-ounce bars, get them to a refinery, refine them into good COMEX gold, 100-ounce bars, get them on a plane, send them to New York. LBMA gold, as long as it stays within the approved refiner and system and so forth like that, it is fungible with New York gold. So they didn't have to do reassays and hard vetting and so forth for the integrity of the bars. All they had to do was like get the physical gold, get it to a refinery, break the bars, and ship them over to New York. So that's, I don't know what the total cost is. Maybe it's $1.50 all in. And they were making 25 or 30 bucks an ounce. So with that kind of margin, you know, this is the kind of risks that you want to take. So what happened was everybody kind of defaulted.
Kind of defaulted.
Yeah.
Yeah.
No, but when everybody's guilty, nobody's guilty,
Okay.
right? So, anyway, Bailey got on a couple of times. He's the muckety muck at the BOE, and he said, "Look, we have the gold. We just don't have it now." You know, and in the world of
It's a
gold,
bit like Bill Clinton saying, "Depends what your definition of is."
yeah, gold people don't like that,
No,
right?
no, I guess not. Yeah,
Well,
we
they
have the
don't.
goal, but yeah, just not
It's
right
a
now.
physical game. You pay cash, you know, and so forth. So you have deals out, like you make commitments. You know, you bought the bars, they've gone to the refinery, and shipped it over there. It's being vetted. It's going to go in. You know, you can't default at the COMEX, otherwise you'd have to buy all that back, and it would be another shit show, right? So
JJ, listen, that's been a great story, and I'm just sitting here listening, and I'm suddenly paying attention to the clock. I'm going to have to say we got to wrap it up, folks. I'm telling you, I read JJ's letter every morning and every evening. He has got insights like this into the gold market, into the energy markets that he trades as well, and certainly in the stock market. We're not going to get into what has happened in the stock market and all that today. We'll have to save that for another time. JJ, I'm so glad to have you come on. I'd love to have you come on again. And I've recommended to our listeners, please check him out. Go to Substack, Market Vibes. And like me, you may become
JJ745 at substack.com.
okay. But if they go to Substack and just type in Market Vibes, they'll eventually find you, right?
Yep, it'll come right to us. Yep.
Okay, my friend, listen, it's been a hell of a week we've had here in the markets in terms of volatility and everything moving around like crazy, and everybody's got their opinion about this, that, and the other thing, and we're going to be closed for a day and a half, and then we open them up again on Sunday. I mean, I wouldn't be surprised if, I don't know, the Dow could be down 5,000 or up 5,000 next week. It just seems to me like a time to keep your cards kind of close to your vest. But maybe like that Swiss friend of yours says, you got to have a view.
You got to have a view. Right now, I think it's time to keep the helmet on, the seatbelt tightly locked, and just watch.
Pace yourself. Well, the folks that are listening to our show know that I often say that my trading process is not about having a lot of confidence that in my crystal ball. That the one thing I try to be really good at is managing risk, and that's my focus. And it sounds like that's exactly what you're saying.
Yeah,
Manage the
you
risk.
don't have to take risks. You can accept risks.
You can accept risk. You can pick your time when you want to take a risk.
Don't create them.
Don't create them. Hey, I've got a sign on my wall here just to remind me, and that is wait for a good location before you enter the market.
I agree.
100%. JJ, thanks, my friend. We'd love to have you back on, and folks, we'll take a very brief break and be right back.
All right. Cheers. See ya.